Hello, everyone. I'm Meg Szabo, and I'm delighted to welcome Sarika Goel, Global Head of Sustainable Investment Research for Mercer, for a conversation on getting to net zero. So, Sarika, as you know, over the last year, we've seen a lot of uptick in the commitments, the net zero commitments coming from investors and trying to align their portfolios. But I think the question remains, what do you do once you have made that commitment? So what do you recommend as the first steps for investors to be taking to align their portfolio to net zero?
Thanks, Meg. Really great to be here. I think in terms of what they need to do, investors really just need to have a good, strong transition plan in place that shows clear targets and trajectories, focuses on a total portfolio perspective, and sets the scene today for what actions are needed for the next, say, 1 to 3 decades out to 2050. Now, supporting climate transition strategies really requires a top-down scenario analysis, forward-looking portfolio analytics, and a bottom-up assessment of holdings. So very much taking that total portfolio holistic approach. Now, there are a number of steps that investors need to take in terms of setting their overall transition plans. What we have seen in terms of best practice includes investors who have authentic goals. So these are leading investors should be setting out clear, authentic, and targeted outcomes to meet their net zero ambitions. They're outcomes focused, so the outcomes should be set with the ultimate beneficiaries in mind and consideration of the future impact of the portfolio and the world. They should absolutely leverage initiatives and frameworks. Now, there are a number of initiatives that have launched in the last several years now, and some of these net zero initiatives, like the GFANs or the the global coalition of leading financial institutions committing to accelerating decarbonization. And really, this group helps, provides collaborative support and helps generate best practice approaches. But also looking at frameworks like the IIGCC, so the Institutional Investors Group on Climate Change, and their net zero investment framework can be a useful source of tools and methodologies to help prioritize the asset classes and form some of these implementation goals. And really a very strong focus on stewardship for change. So the engagement piece is absolutely essential and should be used to encourage transition laggards onto a net zero pathway and to drive better data disclosure. And really what we are seeing, especially from some of these leading investors, is very much they're starting to utilize some of these climate change benchmarks. They're focusing on changing their existing market cap weight benchmarks to something that is low carbon or a Paris aligned version. Monitor the financial performance.
Great, yeah, and I think as you mentioned, benchmarking. We have seen a lot of new indexes coming into play, and obviously the indexes and the benchmarks have kind of been evolving as climate finance and climate investing has also evolved. Can you talk a little bit about where we are with benchmarks now and how clients could navigate those evolving regulations and indexes?
Absolutely. This is one area that has seen significant evolution over the last decade. I mean, responsible investment or sustainable investment indices generally. And the index space has been one starting point for some asset owners in terms of looking at, implementing their net zero commitments. A lot of innovation taking place. Now, we published a paper recently that talks about, looks at the last, few generations of climate indexation. And what we're highlighting here is first generation indices, really focus on managing climate related risks. So such as, those carbon exposures. Second generation climate indices focus not only on managing these climate risks, but also aim to capture some of the climate opportunities, the green revenues. And then the third generation of climate indices really takes this one step forward or multiple steps forward. So captures both those first and second generation indices, but really goes further by identifying companies that are transitioning to a low carbon economy through the commitments that they're making to shift their business strategies that are aligned to net zero. So these third generation indices very much capture this by tilting the index, away from environmentally costly businesses that don't have a transition strategy in place and towards those that are both focused on climate opportunities, but also some of these climate leaders, that are aligned to this transition. you've had
That's really interesting. Sorry.
You had the EU regulated benchmarks that have come in, with specific criteria that, that benchmark administrators need to meet in order to label their indices as, PAB or Paris aligned or climate transition regulated. And these are essentially third generation indices. And really what they're looking at, again, are some of those forward-looking elements, such as the temperature alignment, establishing a business strategy that is, aligned to science-based targets, very much focused on, Scope 3 emissions and ensuring that that's phased in over, now the next few years, and very much that focus on climate stewardship. Now, what this means is there are a number of different and significant different approaches that data provide, which could be around the data input, the assumptions that are used, their views on materiality. And on top of that, this is very much a fast-moving landscape with regulations. And so from our perspective, assessing these types of indices would not be any different to assessing any active strategy. And so any investor that's looking at these should be undertaking this, the same level of due diligence that you would for any active strategy. You've got index construction methodologies that can lead to potentially unintended consequences that, you might not realize if you haven't undertaken that degree of due diligence. They also have to be comfortable with the quality of the inputs and understand how stewardship, can impact the overall score of a company and therefore the rating.
So, looking at that and looking at this evolution of these benchmarks and the indexes and how companies are using them and all these frameworks, how do you then, identify the investments that you want to be, that you would like to have into your portfolio? And then how do you manage them as well?
Yeah, absolutely. So I think beyond the benchmarking, I guess we, when we speak to our clients and work with their overall sustainable investment program, we look at sort of 4 implementation approaches that investors can use to manage their sustainability or their climate risks and opportunities in their portfolios. And really these include ESG integration, so looking at these ESG or climate-related risks and opportunities and integrating that into the overall investment decisions. And the objective here is very much focusing on the broader risks that are not necessarily captured by traditional financial frameworks. Very much focused on stewardship. So this could be at the company, the industry, and policy levels. And specifically here is focusing on engaging and voting where applicable. So the objective is, to make these company improvements through these individual engagements, but also thinking about market and systemic improvements through the collaborative initiatives. We talk about sustainable investments or sustainability themed investments, and that's, looking at some of these climate solutions, sustainable development solutions, and here thinking about that long-term growth prospect, plus having some kind of a positive environmental or social impact potentially added to it. And then where necessary, and this could be very much client-driven, but focusing on the screening and tilting the portfolio away from carbon-intensive companies that are not positioned for transition and potentially risk being stranded.
So you talked a little bit about other emerging trends that are coming out of these trends. What are some of the new trends that are happening in net zero investing?
Absolutely. There are a number of new ideas that are emerging. I mean, we've seen, I guess, our universe of sustainability themes has been one of the fastest growing, albeit from a very small base, but we're seeing a significant number of new ideas emerging. I'd say beyond the index space, where we are seeing a lot of new ideas is in the active equities and fixed income, specifically focused on transition-oriented strategies. So concentrated portfolios that, where managers are essentially investing in companies that are not only providing the climate solutions, so very much geared towards the green or sustainable development solutions, but also targeting investments in companies that are higher carbon intensive, but very good candidates that are, potentially oriented towards a transition, and with them can help to, establish strategies that are then geared towards net zero. So we're seeing a number of new ideas that are very much focused around there. We continue to see a focus on broad environmental strategies. So the launch of, your clean energy type and energy efficiency, a number of new ideas there. A new theme that we've seen in the last couple of years now is very much focused on biodiversity. Now, this is an emerging theme that we would expect to continue to be a key focus in 2022, and that's not least because of some of the commitments that you've heard coming out of COP26 around ending and reversing deforestation, as well as ending investments that are of activities that are linked to deforestation. So we do expect to see a lot more focus on this, and have seen some new ideas emerging there. I'd say from an asset class perspective, equities definitely, but we are seeing new ideas around fixed income as well, specifically in the area of, green, social, sustainable linked, that do have the potential to offer clarity on the use of proceeds. And for that, it does potentially be a good asset class around developing and launching impact-focused investment strategies. Absolutely to note here that this is a very small part of the investment universe of the overall bond market, so roughly 2%, if that. But generally, we have seen managers being, relatively optimistic around these markets.
Yeah, I definitely feel like biodiversity is a term I've heard a lot at COP. So I think we're going to be seeing more of that as we move into 2022 for sure. What about physical risk? How is that being captured as we are seeing a lot more of that coming up as well?
I think most of the focus has very much been on transition risks, and this is where investors are very much accessing investments that are focused on companies that are decarbonizing. The focus on physical risks has more recently been emerging with asset managers, especially like within the public equity and the fixed income markets. And so we have been speaking to managers around this topic, and they're starting to assess the physical risks of their investments by mapping these to global locations, and very much partnering with universities and think tanks, in terms of how they're developing modeling tools, which are increasingly becoming quite sophisticated. And this type of physical risk mapping is happening a bit more on the private market side than within the listed or the public markets. But we do see very few investors that are engaging with companies on this, and so this is something that we would expect to increase definitely over the next year or so.
So we focused a lot of our conversation on getting to net zero and how investors are focused on aligning with net zero targets. What other emerging trends beyond the net zero are you seeing in sustainable investing that are popping up more?
Absolutely. We have seen a lot more momentum happening in the area of impact investing. Now, this is not new, but has definitely picked up in pace over recent years. We recently published a paper on this, really highlighting what we mean by impact investing. And so this is focused on investing with the intention to generate positive, measurable social and environmental impact alongside a financial return. This is different from sustainability-themed investing, which is much broader in scope, and that's focused on investing in strategies that provide exposure to some of these environmental and social opportunities, but where they are viewed as return opportunities with lesser intention of delivering a specific positive outcome. And that's important to highlight because a lot of the ideas that we are seeing are very much focused within the private markets. And that's where it's slightly easier, I guess, to identify that clear, tangible impact that an investment can make. Investors have a much greater ability to influence the way in which projects or assets are managed. And this is very much focused on the provision of new capital to projects and opportunities that would not have been funded otherwise. So very much focused on the additionality piece. In listed equities, this is a bit more of a debate on whether impact can be applied to the same degree or in the same way that we would apply this within private markets. Mainly because, again, the investments focus on trading in the secondary market rather than investing new capital into the system. But there are potentially ways to create additionality specifically through active ownership. And so most of the ideas that we are seeing within the private market space are around, venture capital that are raising impact and sustainability focused funds that are focused on not just climate change and energy transition, agriculture, natural capital, circular economy, water, and healthcare as as some themes.
Great. Well, I think we have covered quite a lot in a short amount of time. I don't know if there's anything else you'd like to end with before we wrap. Is there anything in particular we haven't covered that you think moving into 2022 really investors should be keeping an eye out for?
No, I think there's a lot that's happened in the last, not just in the last year, the last couple of years, but it seems the pace of change and the focus on sustainability and climate, continues to be quite rapid. And so this is definitely an area where, investors of, not just the regulations piece, but new and emerging trends and ideas that are coming out. So think and absolutely great to see the momentum there. So I think we'll have a lot to do.
I completely agree. Really looking forward to continuing to watch this space. Thank you so much for your time. Really appreciate it. And thank you all for joining us.